Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to today's Top Stock Pick segment. Along with Brian Bolin, I am Jeremy Mullen, and I will be doing Phillips 66, ticker symbol PSX. The stock is a Zacks ranked number 2 buy that is an energy manufacturing and logistics company. Phillips operates through 4 segments: midstream, chemicals, refining, and marketing and specialties. The midstream segment delivers refined petroleum to market. The refining segment refines crude into other petroleum products. The chemical segment produces and markets a variety of chemical products, and the marketing and specialties segment markets their products but also deals with other specialty products like lubricants. PSX is up over 50% on the year, but I think there's more room to this move. It is one of the strongest oil names out there, and I've noticed some relative strength lately in the stock. This is while crude oil is starting to see some weakness. So I wanted to dig in the name and find out why it's so strong and look at where the stock might be going. Okay, let's get into it. Okay, here's the profile page for PSX. Phillips 66 is an iconic brand. It was founded in 1875. The company is headquartered in Houston, Texas, and employs 14,000 people. A neat factoid about the company's name: when testing the original product, the specific gravity of the gasoline was about 66. The fuel car testing speed was 66 miles an hour, and the location of the testing was around 66. So naturally, a naming committee got together and went with Phillips 66. So looking at the profile page, the market cap is about 50 billion and has a forward PE of around 5. So this creates a value score of A. So this is as far as valuation goes, investors really like this name. But in addition, you get some growth and momentum. They also have some A's here too. So it gives a VGM of A as well. One of the greatest things about this is the dividend and the money coming back from the company, 3.56%, which is pretty good. And let's look at earnings. This is the price and EPS surprise chart. As you can see, the company beats almost every time. In fact, we only have one miss here over the last few years. And looking at last quarter, we have a nice 30% EPS beat. And this quarter, the numbers were released just a couple of weeks ago, and this was a 7th straight beat. Sales for the quarter were up 100% versus a year ago, and the refining business improved market capture. And with the oil prices so elevated, the company just continues to perform. The print came in at $6.46 versus the $4.98 expected. CapEx was up to $735 million versus the $376 million expected. So they are investing back into the company because the oil prices are so high. The more they invest, the more return they can get on that capital invested. The company also announced a $5 billion buyback, which is 10% of the market cap. They plan to return $10 to $12 billion by the end of 2024. So a lot of money coming to shareholders in the next couple of years in the form of buybacks and dividends. So that dividend we talked about is likely very secure, if not going higher. Other notes on the quarter: Phillips 66 is enhancing refining performance by taking action to increase reliability, improve market capture, and reduce costs. They plan to increase adjusted EBITDA by $3 billion over the next 3 years and expect to achieve this growth through its proposed 87% interest in the DCP midstream, execution of Rodeo Renewed and other projects, as well as sustainable cost reductions from its business transformation. Looking at the estimates now. So what are the analysts saying? As you can see, as far as the amount of estimate revisions, we see everything is going higher for the most part, some lower next year, but for the most part, all the analysts are on board taking estimates higher. Looking at the actual numbers, we can jump down here and look at the magnitude. So we see over the last 30 days since earnings, we see a huge jump across the board. So for the current quarter, we see a 35% jump. Next quarter, not as aggressive, but looking at next year, we see a 22% jump, or for current year, 22%, and next year, we see a 23% jump. So along with rising estimates, we're seeing price targets go higher as well. Some recent ones were RBC. They reiterated their outperform, and they have a new price target of 131, which is up from 119. BMO is on board as well. They have an outperform rating and a target of 125. So let's look in the charts and see how we might get there. Okay, I wanted to show the chart going all the way back almost 10 years. You can really see the stock just meandered around this $80 level. This is a big level. Investors basically looked at this level as the fair value for the company. But then in 2017 and 18, it started to break out and then had problems with the 120 level, came back down to the 80 level, back up to 120 in like 2019, but then COVID hit and obviously fell apart. Now, I would like to take that COVID year out of it and just kind of look at this $80 level like, wow, this really, it's been trading around this level basically for almost 10 years, with some extensions up and down, of course. Now, so what we want to see now is a retest of this 120. We want to see it get back up here and see what the reaction is. I would think that we could easily get up here just how this is trading, and then we might see some resistance or we might see it break through. So let's kind of zoom in to the recent trading action and see how we might get there. If you guys know me, you know I like Fibonacci's, and what I have here is a 61.8. If you draw from these June highs to lows, we had a 61.8 that saw some resistance in early October, but then we kind of broke through and we've been grinding higher. So what happens when these breaks? You look at the extension, which is a 161.8 extension here at 133. So that's going to be my target. So in addition to that, we look at the moving averages, and this green line is a 21-day. As long as it stays out of the above the 21-day, the short-term trend is intact. The momentum is intact. So what I'd like to see is for that to hold and extend higher. Now, we're trading lower today. The oil's pretty weak, so we could see that break. For those that are interested in the stock, the next level you want to look out for is these 50-day moving average at 95 or the 200-day moving average at 90. Now, I don't know if we can get down here unless we see an aggressive sell-off in oil. Obviously, these earnings were pretty good, and there's some buying coming in. But eventually, on the longer term, we're going to look for these to hold and extend higher, perhaps early into next year, maybe the middle of the year we get up there. So technically looking very, very bullish, and I would definitely be buyer on these dips. The relative strength here in PCX is very noticeable. Even with the price of oil going down, the stock has held up well. The previous highs in 2018 and 19 are in play. The only question is if that 120 level gives way and the stock can actually break out to much higher levels. Considering the cash coming back to investors over the next couple of years, the stock likely holds up even if crude comes in a bit. Look for PSX to continue higher into year's end and be a leading energy name into 2023. Okay, that's it for me and my top stock pick. Here is Brian Bolin with his.
Thanks for that wonderful top stock pick from Jeremy. And now it's my turn, and I am Brian Bolin, and I am the aggressive growth stock strategist here at Zacks. And I've got a top stock pick for you that's going to work in a recession or not in a recession. So let's go right ahead and take a look at it. Carparts.com. PRTS. That is my top stock pick for the week. It is a Zacks rank #1 strong buy. It's got a C for value and a B for growth. And usually on my aggressive growth stock videos, I like to see a strong growth score and a weak value score because that tells me right away I am on the right path. But for this instance, we're talking more about, a top stock pick for the week. So I'm not overly concerned about the growth divergence here. But we can see from this chart right here that there was an earnings event a week or so ago, and the stock has been moving higher, and we think that that's going to continue. We're going to get that post-earnings drift higher. So let's take a look at all the normal things we love to look at here in a stock. So is it beating the number? And over the last 4 quarters, we can say, yes, it has been beating the number, and it's been beating the number soundly. The average has been a 100%, 100% above the Zacks consensus estimate. So where are estimates headed? And we can see, minus 14 cents down to a loss of minus 13 cents for this quarter. Next quarter, from break even up to 3 cents, a loss of 11 cents down to a loss of 3 cents. That's good. And a loss of 12 cents down to a loss of 5 cents. So all the estimates moving in the right direction. And let's take a sneak peek at the top line growth here. We can see it's actually pretty steady. We're looking at 13% for this year, 12% for next year. So that's all good. So now let's jump to the valuation. And we are running a loss. So immediately we know our forward multiple is going to be an NA. But we can see where growth has been 16%, and we can see where price to book is 2.6%. Value investors love a stock below 3 times book, so that's good to see. The other thing that's really good to see here is operating margins going from negative 0.9 to negative 0.5 to just break even here. And I guess the story really is this most recent beat. It was a good sized beat, and things are starting to look up for this company. Now, the real idea here is that estimates are moving much higher. The stock has come down quite a bit, from mid-double, 18 or so right there over the last year or so. And we're headed into a potential recession. Are we in recession? Were we in recession? There's definitely an economic slowdown. And when that happens, people are going to be trying to fix their own cars. The used car prices are super high. So when we think about parts.com, this is where people are going to be trying to save money, skimp. So PRTS, that's my stock pick for the week. That's it for this time. Be sure to join us next time on Zacks Top Stock Picks.